The journey of Richard Wyckoff is the embodiment of the American dream on Wall Street. He began his career at the lowest rung of the ladder, as a stock runner at the age of 15. He did not possess a formal university education or a wealthy family inheritance. His education was the tape itself, and his university was the trading floor. Over the course of 33 years, through relentless study, meticulous observation, and active participation in some of the most dramatic market cycles in history, he rose from a simple courier to the head of his own respected brokerage firm. This long and arduous journey provided him with a unique and intimate perspective on the market's inner workings. He was not an academic in an ivory tower. He was a practitioner in the trenches. His 33 years of experience were not spent theorizing, but testing, failing, refining, and ultimately succeeding. This immense body of practical knowledge allowed him to cut through the noise, the complexity, and the outright deception of Wall Street, and to crystallize the universal, unchanging laws of market success into a series of clear, actionable, and inviolable rules. These are not suggestions or helpful hints. They are the foundational commandments of scientific speculation. Today we will study the first 5 of these 15 golden rules, which together form the complete blueprint for the mindset and preparation of any professional trading campaign. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. And remember to return to the channel in difficult times when trading isn't well. Golden rule number 1. You must always determine the current position and the probable future trend of the general market. This is the first, highest, and most important rule of all. Before a professional speculator ever considers the merits of an individual stock, he must first perform a thorough diagnosis of the health of the entire market. To ignore the general market trend is the equivalent of a sailor setting out on a voyage without first checking the weather, the tides, and the direction of the prevailing winds. The individual stock is but a single ship, and the general market is the great and powerful ocean upon which it sails. No matter how seaworthy the ship, it cannot long sail against a powerful and determined tide. The daily and weekly work of a professional, therefore, begins with a careful and dispassionate study of the major market averages. These averages, representing the composite action of hundreds of the most important stocks, are the most reliable barometer of the market's true condition. Their movement reflects the collective judgment and the concerted campaigns of the most powerful and well-informed financial interests in the world, the entity we personify as the composite operator. The objective of this analysis is to determine which of the 4 great market phases is currently in control. Is the market in a phase of accumulation, a basing process where the composite operator is quietly absorbing supply in preparation for a new advance? Is it in a markup phase, a clear and sustained uptrend where demand is in control? Is it in a phase of distribution, a topping process where the composite operator is methodically selling his holdings to an optimistic public? Or is it in a markdown phase, a clear and sustained downtrend where supply is in control? A campaign on the long side can only be planned and executed with a high probability of success when the general market is in a confirmed markup or in the final stages of a confirmed accumulation. To attempt to buy stocks while the general market is showing clear evidence of distribution or is in an active markdown is a strategic error of the first magnitude. It is an attempt to swim upstream against a powerful current. While it is true that a few rare stocks may occasionally buck the trend, the overwhelming probabilities are that the majority of stocks will be carried downward by the general market's weakness. The professional speculator is a student of probabilities, not an exception hunter. He waits until this most powerful of all market forces is aligned in his favor. This single rule, when applied with unwavering discipline, will protect your capital from more danger than any other. Golden rule number 2. You must judge the market and all individual stocks only by their own action. This is the great rule of intellectual independence. The professional speculator is a scientist of the tape. His conclusions are based on evidence, not on opinion. The only source of pure, unadulterated evidence about a stock's probable future course is its own price and volume action as recorded on the tape. Everything else is noise. The novice trader is constantly buffeted by a storm of external information. He reads the news headlines, he listens to the confident predictions of television pundits, he scrolls through the endless stream of tips and rumors on social media, and he pays heed to the pronouncements of so-called experts. He believes that by gathering more of this external information, he is gaining an analytical edge. This is a profound and costly delusion. The vast majority of this information is, at best, a lagging indicator of events that have already been discounted by the market. At worst, it is a deliberate and sophisticated form of manipulation designed to mislead the public at critical market junctures. The best news is almost always disseminated at the very top of the market to provide a plausible reason for the public to buy the shares that the insiders are desperately trying to sell. The professional, therefore, trains himself to become deaf to this noise. His focus is singular and absolute. He studies the chart. He analyzes the relationship between the effort, as revealed by the volume, and the result, as revealed by the price spread. He asks himself, what is the tape telling me? What is the composite operator doing? Not what are the newspapers saying. He knows that every piece of information, every fundamental development, every hope and every fear is ultimately reflected and synthesized in the price and volume action. The tape is the final arbiter. It is the court of last resort. If a glowing news story about a company is released, but the chart shows clear signs of professional distribution, the professional trusts the chart and ignores the story. This rule requires the development of supreme self-reliance and the courage to stand apart from the crowd. It is the foundation of all clear and profitable market judgment. Golden rule number 3. You must never enter a trade without a clear and well-formulated plan. The act of speculation is not a series of impulsive reactions to market stimuli. It is the methodical execution of a series of premeditated, well-reasoned business plans. An individual trade is a single business venture. To commit capital to such a venture without a clear plan of action, without a defined objective and a strategy for managing risk, is not speculation. It is pure gambling. This rule demands that before any order is ever placed, the operator must first create a written plan. The physical act of writing down the plan forces clarity of thought and imposes a critical layer of discipline. This plan does not need to be complex, but it must contain several non-negotiable components. First, it must state the precise evidence-based reason for the trade. This is the why. Second, it must define the exact conditions for entry, the specific price level, and the confirming action required to initiate the position. This is the when and where. Third, it must establish the logical stop-loss point, the price at which the original thesis is proven wrong and the loss is to be taken without hesitation. This is the what-if. Fourth, it must contain a logical price objective, an estimate of the trade's potential based on the preceding cause. This is the what-for. If you cannot articulate these basic components of a plan, you have no logical basis for the trade, and you have no right to risk your capital. The professional speculator is a planner, a strategist. He anticipates, he prepares, and he acts only according to his plan. The amateur, by contrast, is a reactor. He is constantly surprised by the market's movements and is forced to make critical financial decisions in the heat of the moment, under the influence of powerful emotions. This rule is designed to force you to do your thinking when you are calm, rational, and objective, before you have money on the line, so that when the time comes to act, your job is not to think, but simply to execute the plan you have already made. Golden rule number 4. You must study your mistakes, especially those that result in a loss. In the course of his 33-year career, Richard Wyckoff undoubtedly made thousands of trades. Not all of them were winners. He understood that losses are an inevitable and unavoidable part of the business of speculation. The difference between the successful professional and the chronic loser is not that the professional avoids losses, but that he learns from them. Every losing trade is a lesson. It is a piece of market tuition for which you have already paid, often dearly. The amateur trader, pained by the loss, will attempt to forget the experience as quickly as possible. He will blame the market, he will blame his broker, he will blame a tip he received. He will do anything but conduct an honest and searching post-mortem of his own actions. By doing so, he guarantees that he will repeat the same mistake in the future. The professional, by contrast, understands that his logbook of losing trades is his most valuable educational resource. He keeps a detailed trading journal for this very purpose. For every trade, and especially for every loss, he conducts a thorough and brutally honest review. He asks himself, where precisely did my process fail? Did he violate his own rules? Was his analysis of the general market incorrect? Did he misinterpret the volume signature? Did he chase a price out of impatience? Did he allow an emotion like greed or fear to overrule his judgment? He seeks to identify the exact point of failure in his own analysis or execution. This process of systematic self-correction is the fastest and most effective path to developing sound market judgment. It is through the painful but priceless lessons of your own mistakes that your weaknesses are exposed and your skills are forged. The market is constantly providing you with feedback. Rule number 4 is the commitment to listen to that feedback, to learn from it, and to ensure that you do not pay for the same lesson twice. This video will give you the foundational rules of the Wyckoff method. But to apply these rules with the conviction of a professional, you need to understand the judgment that forged them. That judgment is the very heart of Richard Wyckoff's masterwork. How I Trade and Invest in Stocks and Bonds. This book is not a dry technical manual, it is the record of a 33-year career on Wall Street. Inside, Wyckoff shares his own campaigns, detailing the logic behind his profitable trades in stocks like U.S. Steel and his long-term speculative investment in Magma Copper. He dissects the methods of other market titans, analyzing the principles of legendary operators like Jesse Livermore and his double-stop rule, the industrialist E.H. Harriman, and the aggressive pool operator James R. Keene. You will learn his practical methods for building a defensive portfolio with bonds, his hard-won rules on the grave dangers of averaging down, and above all, the ultimate skill, how to develop independent forward-looking judgment. The best way to access this timeless wisdom is through the modern adapted edition by Max Davidson. Its annotations act as your personal guide, translating the historical context for today's markets, and it includes illustrations of the very traders Wyckoff used as examples. If our videos teach you the what, this book teaches you the how and the why. It is a complete course in building a professional mind. The link is in the description. Golden rule number 5. You must always preserve your capital. Profit is a secondary consideration. This is the final and most important of our foundational rules. It is the bedrock upon which a long and successful speculative career is built. The amateur enters the market thinking only of the profits he can make. The professional enters the market thinking first and foremost of the risks he must manage. The amateur seeks reward. The professional seeks to control risk, knowing that the rewards will then take care of themselves. The primary job of a speculator is not to generate returns. It is to manage risk and to preserve his trading capital. Capital is the essential tool of your trade. Without it, you are out of business. Therefore, its preservation must be your highest and most sacred duty. This is not a philosophical ideal. It is a mathematical necessity. A 50% loss in your trading capital requires a 100% gain just to get back to where you started. A 75% loss requires a 300% gain. The mathematics of large losses are a brutal and unforgiving tyrant. This rule is put into practice through the unwavering application of strict position sizing. As we discussed in the first rule, this means risking only a small fixed percentage of your total trading capital on any single idea, typically 1 or 2%. This is not a guideline to be followed only when it is convenient. It is an absolute, non-negotiable law of operation. It is what separates the professional operator from the gambler. A gambler may risk a large portion of his stake on a single turn of a card, hoping for a life-changing win. A professional, like a casino owner, knows that he will have many small losses, but that his statistical edge will ensure his profitability over the long run, provided that no single loss is ever allowed to be large enough to jeopardize his business. By adhering to this rule, you are ensuring your own longevity. You are mathematically guaranteeing that you can and will survive the inevitable strings of losing trades that every single speculator, no matter how skilled, must endure. You are giving yourself the time and the opportunity to learn, to grow, and for your sound methodology to eventually bear fruit. Profit is the goal, but it is a goal that can only be achieved as a byproduct of a relentless and uncompromising focus on the preservation of your primary asset, your capital. Having established the 5 foundational rules that govern the professional speculator's mindset and preparatory work, we now transition from the realm of broad philosophy to the specific tactical application of the Wyckoff method. The following 5 rules are concerned with the analytical process itself. They are the rigorous, evidence-based filters that Richard Wyckoff applied to the daily and weekly work of selecting the correct securities and, just as importantly, choosing the precise moment to act. These rules bridge the gap between strategic intent and tactical execution. Golden rule number 6. You must trade only the leading stocks in the leading groups. A professional campaign is never conducted with inferior instruments. Your capital as a speculator is your primary and most precious asset. It must be deployed only in those vehicles that offer the highest probability of a swift and profitable return. In the stock market, these vehicles are, without exception, the market leaders. The amateur trader is often drawn to the laggards, the stocks that have not yet moved, believing them to be undervalued or due for a catch-up rally. This is a fundamental error in reasoning, a speculation based on hope rather than on the clear evidence of the tape. The composite operator, the great informed intelligence that drives market trends, does not waste his time or his immense capital on second-rate securities. He concentrates his buying power in a select handful of stocks that possess the greatest potential for leadership. These are the stocks with the strongest fundamental positions, the most promising future prospects, and the most responsive technical action. Our job as scientific speculators is not to guess which stocks these might be, but to identify them by studying their action on the chart. The primary tool for this is the principle of relative strength. This is not a complex indicator, but a simple, direct, and powerful method of visual comparison. After you have determined, according to rule number 1, that the general market is in a favorable uptrend, your next task is to identify the strongest industry groups within that market. By comparing the charts of the various sector indices to the chart of the general market average, you can quickly identify those groups that are outperforming. These are the sectors where the composite operator is focusing his efforts. Having identified these leading groups, you then apply the same comparative test to the individual stocks within those groups. A true leader is a stock that is outperforming its own sector. It is the stock that rises faster and further on rallies and that corrects less on declines. This superior price action is the market's own unambiguous declaration of professional sponsorship. It is the footprint of the composite operator's aggressive accumulation. To buy a leading stock is to align your own smaller operation with his great campaign. You are placing your capital in the same vehicle that the smartest money on Wall Street has already chosen. To buy a laggard, conversely, is to bet against his judgment. It is to choose a weaker instrument in the hope that it will somehow outperform the strongest. This is not a logical basis for a professional operation. This rule, when applied with discipline, forces you to focus your analytical energy and your capital only on the A-class candidates thereby dramatically increasing your probability of success. Golden rule number 7. You must ensure that the cause is sufficient for the anticipated effect. A good trade, the only type of trade a professional considers, is one that offers the potential for a substantial profit. A significant market move, the effect, does not arise from nowhere. It can only be the result of a commensurate and preceding period of preparation, the cause. This is the essence of Wyckoff's great law of cause and effect. This rule demands that before a campaign is ever initiated, the speculator must first conduct a thorough analysis of the preparatory phase to ensure that it is substantial enough to produce the profitable move he seeks. This cause is the base of accumulation that is built by the composite operator following a decline. This trading range, which may appear to be a period of dull, sideways action to the amateur, is, in fact, the most critical phase of the entire market cycle. It is the period during which the composite operator is methodically and patiently absorbing the floating supply of a stock, thereby laying the foundation, or building the cause, for the subsequent markup phase. The extent and duration of this cause are of paramount importance. A short, narrow, and ill-defined base that forms over only a few weeks is a small cause. It indicates that only a limited amount of stock has been accumulated, and it can, therefore, only be expected to produce a limited and modest price advance. A great campaign must be launched from a great cause. The professional speculator, therefore, searches for stocks that have undergone a long, broad, and well-defined period of accumulation, often lasting for many months. The greater the amount of time and effort the composite operator has expended in building this cause, the greater his own profit motive will be, and the more extensive the subsequent uptrend is likely to be. To quantify this cause, Wyckoff employed the point and figure chart. By performing a horizontal count of the columns within the point and figure accumulation pattern, the analyst can derive a logical, evidence-based price objective for the coming move. This count is the mathematical expression of the cause. A campaign is only considered if this count indicates a potential reward that is a large multiple of the initial risk. This rule ensures that your capital is only ever committed to opportunities that offer truly significant potential. Golden rule number 8. You must never buy while the supply is still dominant. You must wait for the proof that it is exhausted. A military campaign is not launched while the enemy's forces are still strong and entrenched. It is launched only after those forces have been attrited and weakened. In market terminology, this means that a long position is never initiated until there is clear, unambiguous evidence on the chart that the selling pressure, the supply, has been fully and finally absorbed. To act before this point is to buy into a situation of uncertainty, where a latent and overwhelming wave of selling could emerge to jeopardize your campaign. This rule requires the disciplined, patient observation of the entire sequence of events that constitutes a classic Wyckoffian accumulation. The analyst must have the fortitude to stand aside until every piece of the puzzle is in place. He must first see the stopping action of the prior downtrend, typically a selling climax. He must then patiently observe the long process of absorption within the subsequent trading range, confirmed by the characteristic diminishing of volume on declines. Most critically, he must wait for the final, decisive test of the supply. This is the event that occurs in Phase C of the accumulation process. It is the spring or shakeout. This is the final bearish trap, a deliberate thrust below support designed to dislodge the last of the weak holders and to mislead the bears. The successful completion of this test, proven by the price's rapid and decisive recovery back into the trading range, is the ultimate, definitive proof that the selling pressure has been purged from the market. The absence of a clear and conclusive test of the supply is a critical red flag. To act without this final piece of evidence is to engage in guesswork. This rule demands that you wait for the market to prove to you that the sellers are gone. Wyckoff's method provides a masterclass in reading the internal action of the market to build a trading plan. It's a deep forensic analysis. However, it is essential to recognize that other market titans had entirely different, yet equally disciplined, daily routines. Bernard Baruch, for example, based his decisions on a deep understanding of geopolitical events and fundamental economic shifts. Nicholas Darvas used his mechanical box theory, a system that ignored almost everything except price action. Richard Dennis and his turtles were given a simple set of rules, a complete trading plan they had to follow mechanically. To provide you with a comprehensive education on these diverse but equally potent methodologies, we created our new channel, Trading Insights. It is dedicated to the practical strategies and success stories of these legendary speculators. To see how different masters built their success, we invite you to subscribe and watch. The link is in the description. Golden rule number 9. You must never chase a breakout. You must await the confirmation. This rule governs the precise timing of the entry. It is a direct and powerful antidote to the amateur's greatest emotional weakness, the fear of missing out. After a long period of accumulation, the initial move out of the trading range, the sign of strength, is often powerful and exciting. The novice trader, seeing this breakout, is seized by an irresistible impulse to act immediately, fearing that the move will get away from him. He chases the price higher, buying at the peak of the excitement. This is a profound tactical error. The professional operator, by contrast, never chases a breakout. He views the sign of strength not as a command to buy, but as the final confirmation of his analysis. It is the last piece of evidence he requires. Having received this confirmation, he then exercises a final and most refined form of patience. He waits for the market to present a secondary and far safer point of entry. This is the last point of support, the first natural pullback or reaction that occurs after the initial breakout. This pullback is a moment of supreme analytical clarity. It is the market's own test of the breakout. The professional's final act is to judge the character of this test. He must demand to see that this pullback occurs on light, significantly diminished volume. This drying up of the volume is the final, irrefutable proof that the supply is exhausted and that the path of least resistance is now clear to the upside. An entry at this last point of support is the safest, most logical, and most professional point of commitment in the entire Wyckoff methodology. It is an entry made in a moment of calm, with a clearly defined and minimized risk. This rule is absolute. You must let the market confirm its own strength before you commit your capital. Golden rule number 10. You must use the point and figure chart to determine the logical objective of your campaign. As we established in rule number 7, a campaign is only undertaken if the potential reward is substantial. The point and figure chart is the primary tool that Richard Wyckoff used to transform this concept from a general idea into a specific, quantifiable objective. The practice of conducting a horizontal count from a point and figure accumulation base is not an academic exercise. It is an essential and practical step in the planning of a professional campaign. By calculating the minimum and maximum price objectives for a trade before it is ever initiated, the speculator gains several critical advantages. First, it provides the final and most important input for his risk-to-reward calculation. He can now weigh his small calculated risk, as defined by his stop-loss, against a large, logically derived potential reward. This ensures that his capital is only ever deployed in opportunities that offer a highly favorable asymmetric payoff. Second, having a clear price objective provides a vital psychological anchor during the course of the campaign. It provides the logical justification for holding a position through the inevitable minor corrections that punctuate every major trend. When you have a sound, evidence-based reason to believe that a stock has the potential to advance by another 50 points, you are far less likely to be frightened out of your position by a minor 2-point dip. It provides the fortitude required to let your profits run. Finally, the price objective provides a logical framework for concluding the campaign. As the price approaches the target zone projected by the point and figure count, the professional operator knows that the campaign is nearing its logical conclusion. He can then begin to watch the bar chart with heightened vigilance, looking for the first signs of a new campaign of distribution. This rule, therefore, closes the loop. It connects the cause that was built during the accumulation to the effect that is realized during the markup, providing the campaign with a logical beginning, a middle, and an end. It is the final piece of the analytical puzzle. We have now journeyed through the first 10 of Richard Wyckoff's Golden Rules, covering the essential principles of strategic preparation and tactical analysis. We have learned how to assess the battlefield, how to select our targets with precision, and how to wait with disciplined patience for the market to provide a full and complete body of evidence. We now arrive at the final and most critical phase of our study. The following 5 rules govern the realm of action, of execution, and of the unshakable psychological fortitude required to transform a well-laid plan into a profitable campaign. It is at this stage that all the preceding analytical work is put to the ultimate test, where the operator's discipline becomes the final and deciding factor between success and failure. Golden Rule number 11. You must always employ a protective stop-loss order. This rule is absolute, inviolable, and foundational to a professional career. The failure to use a stop-loss is not a minor oversight. It is an act of gross professional negligence. Richard Wyckoff, in his observations of the thousands of traders who met their ruin on Wall Street, identified the refusal to limit a loss as the single most common and direct cause of financial catastrophe. An amateur trader often views a stop-loss as a negative, an admission of a mistake or a pessimistic expectation of failure. The professional understands that the stop-loss is, in fact, one of his most powerful and positive tools. It is not a prediction of failure. It is a form of professional insurance. Just as a prudent businessman would never operate a valuable factory without insuring it against the risk of fire, the professional speculator would never commit his valuable capital to a position without insuring it against the risk of a catastrophic, unforeseen price move. The stop-loss is that insurance policy. The small predetermined loss that it represents is the known and acceptable premium that he pays to protect himself from a large, unpredictable, and potentially ruinous event. The placement of this stop-loss is not an arbitrary or emotional decision. It is an integral part of the initial campaign plan, as established in Rule number 3. It is placed at a specific, logical price point that definitively invalidates the original, evidence-based thesis for the trade. For a long position initiated at a last point of support, the stop is placed just below that support area. A decline to that point is the market's own declaration that the analysis was incorrect. The professional accepts this verdict without argument or ego, takes his small, planned loss, and preserves his capital to fight another day. He understands that his job is not to be right on every single trade, but to ensure that his winning campaigns are substantially larger than his losing ones. This is only possible if the losses are always kept small and under absolute control. The stop-loss is the primary tool for achieving this. Golden Rule number 12. You must never, under any circumstances, average down a losing position. If the failure to use a stop-loss is a form of professional negligence, then the act of averaging down is a form of financial suicide. It is the single greatest and most destructive sin a speculator can commit. This is the practice of buying more of a stock as its price falls, in the hope of lowering one's average cost. It is an act born not of logic or evidence, but of ego and a desperate, irrational hope. Let us dissect the flawed psychology behind this act. A speculator buys a stock based on a sound analysis. The stock then begins to move against him. His initial analysis is now being called into question by the market's own action. Instead of respecting this new evidence and exiting the position for a small, controlled loss as his stop-loss would dictate, the amateur, driven by his ego's desire to be proven right, concludes that the market is wrong. He views the lower price not as a warning, but as an even greater bargain. He buys more. As the price falls further, his conviction, now completely detached from the evidence of the tape, only deepens. He buys still more, throwing good money after bad in a desperate attempt to vindicate his original opinion. He's no longer trading. He's engaged in a personal argument with the market, an argument that the market will always win. Richard Wyckoff was unequivocal on this point. He taught that the first loss is almost always the smallest and best loss. To add to a position that is already showing you a loss is to compound a strategic error. It is to increase your risk at the very moment when the evidence is turning against you. A professional campaign is one in which the operator adds to his position only when it is showing him a profit, a practice known as pyramiding. He adds to strength, not to weakness. Rule number 12 is therefore the great dividing line between the professional and the amateur. The professional exits a losing trade at the first sign of trouble. The amateur, by averaging down, chains himself to his mistake, ensuring that a small, manageable loss will grow into a large and often fatal one. Golden rule number 13. You must cut your losses short and let your profits run. This rule is the great mathematical and psychological secret to all speculative success. It is the principle of positive asymmetry. The speculator who can successfully implement this rule over a long period of time is mathematically guaranteed to be profitable, even if he is correct on fewer than half of his trades. The speculator who consistently violates this rule by doing the opposite, taking small profits and letting his losses run, is mathematically guaranteed to fail. The first half of this rule, cut your losses short, is the practical application of rule number 11. It is the discipline to predefine your risk with a logical stop-loss and to accept that small loss without hesitation or regret the moment the market proves your judgment wrong. These small losses are not failures. They are the routine, unavoidable, and necessary business expenses of a professional speculative operation. The second half of the rule, let your profits run, is psychologically far more difficult, but it is where all great fortunes are made. The natural human impulse upon seeing a small open profit in a position is one of fear, the fear that the profit will evaporate. This fear creates an almost irresistible urge to sell the position and to book the small gain. The amateur consistently succumbs to this impulse, snatching a series of small, satisfying profits, but never allowing himself to participate in the one or two great trending moves that could make his entire year. The professional, by contrast, has a plan. He has, according to rule number 4, a logical price objective for his campaign, an objective that is based on the magnitude of the preceding cause. He understands that the purpose of a good trade is to capture the majority of this projected move. He therefore employs the trailing stop, as we have discussed in previous studies, as his primary tool for achieving this. By methodically moving his stop-loss up under each successive reaction low, he forces himself to remain in the position, allowing him to ride the trend through its natural minor corrections. This rule is the engine of profitability. It ensures that his winning campaigns are, on average, a large multiple of his losing trades, creating the positive mathematical expectancy that defines a successful professional career. Golden rule number 14. You must master the art of patience, both in waiting for an opportunity and in managing it. We have touched upon this principle in our previous rules, but its importance is so profound that it deserves to be enshrined as a golden rule in its own right. Richard Wyckoff, in his observations of the great operators of his day, noted that their most common and most powerful characteristic was not their intellectual brilliance, but their almost superhuman capacity for patient, dispassionate waiting. This patience manifests in two critical forms. First, there is the strategic patience required to wait for a true, high-probability opportunity to present itself. This is the discipline to follow your analytical process, to apply all your filters, and to stand aside with your capital in cash for days, weeks, or even months if necessary, until that one single setup appears that meets every one of your exacting criteria. The amateur is a slave to his need for action. The professional is a master of strategic inactivity. The second form is the operational patience required to manage a winning position correctly. This is the fortitude to remain in a trade and to let it run to its logical conclusion, as dictated by your initial analysis and managed by your trailing stop. It is the discipline to resist the fearful impulse to take a small profit and to allow a good trade the necessary time to become a great trade. This rule underpins all the others. Without patience, a sound analytical method is useless, as it will never be given the chance to work. It is the ultimate weapon in the professional speculator's arsenal. Golden rule number 15. You must strive for one good trade rather than for constant activity. This is the final rule, and it is the culmination of all the principles we have discussed. It is the great unifying philosophy of the Wyckoff method. Your goal as a developing professional is not to become a more active trader. It is to become a more selective one. You must abandon the amateur's belief that success is measured by the frequency of one's trades. Success is measured only by the quality of one's decisions. The pursuit of one good trade is a commitment to excellence over action. It is the understanding that one single, perfectly analyzed, patiently awaited, and flawlessly executed campaign is of infinitely greater value to your financial and professional development than 100 impulsive, ill-conceived, and poorly managed trades. This philosophy is a complete operational mindset. It forces you to be disciplined. It forces you to be patient. It forces you to adhere to every single one of the preceding 14 rules, because a trade cannot be a good trade unless it has met every one of these exacting criteria. This final rule transforms your entire approach to the market. You are no longer a hunter of random, fleeting opportunities. You are a professional specialist, a connoisseur of A-class setups. You understand that these opportunities are rare, and you have the confidence and the discipline to preserve your capital and your mental energy for those few moments in a year when the probabilities are overwhelmingly aligned in your favor. This is the final and highest stage of a speculator's development. This video provided a 10-step blueprint for planning a trading campaign. But the ability to execute this plan under pressure, to make sound judgments in the heat of the moment, requires more than just rules. It requires a professional mindset. Richard Wyckoff's essential work, How I Trade and Invest in Stocks and Bonds, is the ultimate guide to forging that mindset. It's not just a book of charts. It's a record of his own campaigns. Wyckoff details his reasoning, his successes, and his failures, teaching you the foundational principles of judgment that turn a set of rules into a winning strategy. If you want to move from being a technician to becoming a true market strategist, this book provides the indispensable wisdom to make that leap. It teaches you how to think. In our final conclusion, we have now laid out the 15 golden rules that were the product of Richard D. Wyckoff's 33 years of experience on Wall Street. These are not a loose collection of tips or suggestions. They are a complete, integrated, and logical system of thought and action. They cover the full spectrum of a professional operation, from the foundational principles of mindset and capital preservation, through the specific rules of tactical analysis, and culminating in the inviolable laws of execution and discipline. The consistent, unwavering application of this complete set of rules is what transforms speculation from a hazardous game of chance into a sound and profitable professional business. Your task is to study these rules to understand the deep logic behind them and to make them the unshakable foundation of your own market operations.